an even more interesting second half.
Yeah, we've seen a huge contrast in terms of the tanker market between 2015 and 2016. And freight rates this year have certainly come off in quite dramatic style following spikes in 2015. And I think that's in part driven by the huge changes we've seen in the oil market in terms of low prices in 2015 driving up demand and refinery throughput, and that supported global trade and increased imports in key regions like China, but also in areas like Western Europe and other Far Eastern refining regions such as South Korea. Those regions effectively peeled away from core drivers like China in 2016, and the demand side of the market's really softened off this year.
One of the stories of the first half was, of course, floating storage and its likely impact on the market. But do we see that receding in the second half?
Yeah, we don't see a lot of evidence for floating storage happening at the moment. What we have seen is a lot of congestion in the first half of the year, which some can equate to kind of floating storage, as vessels have been waiting in ports following impediments to discharge from high levels of inventories and things like that. But actually the floating storage on a commercial basis, which we saw high levels of around 2009, driven by a contango in the crude price, actually really hasn't been evident because crude prices have been depressed. Actually the forward curve has been quite flat and hasn't really generated enough forward revenue for traders to play that. So actually floating storage levels really have been driven by congestion factors. And what we've seen is in regions like the Middle East and like in China, where we've seen high levels of port congestion in the crude sector, as production in areas like Iraq has ramped up and China has taken in a lot of crude. A lot of that's eased off in the second half of the year as well. So we're not really seeing the kind of anecdotal evidence for large port delays for VLCCs in regions like that. And that's also contributing to some of the softness in the freight market in the second half of 2016.
As we speak on the container side, obviously Hanjin is attracting a lot of news. Is the tanker market going to have its own Hanjin?
Well, I think the tanker market, again, we talk about contrasts, and really the tanker market has been in huge contrast to the dry bulk and container ship sectors over the last year or so, with much stronger rates and seemingly a lot more kind of robust earnings effectively, whereas those two markets have been in the doldrums for some time. At the moment, it's really early in terms of how we can assess the tanker market. We're seeing much lower freight earnings. MSI expects conditions to be relatively soft over the next year and a half, but actually we're not expecting kind of catastrophic earnings levels or a repeat of what we saw in 2013, for example, in the crude market, which really was a extreme trough in earnings levels. So at the moment, in the short term, we're expecting some kind of stabilisation in rates, I would say, and we're not anticipating the kind of corporate problems that we've seen recently in the container sector and we saw in 2013 in the tanker sector.
Of course, new building orders have nosedived, and if you look at the forward book for deliveries, that also will nosedive over the next 2 to 3 years. How do you expect that to impact the market?
The depression we're seeing in the market has been driven to a large extent by the supply side. So deliveries, and particularly for large crude tankers, really had been on a kind of hiatus following the deep troughs we saw in 2013 and the lack of ordering there. And they've really recovered, so we're seeing a lot more tonnage hitting the water this year, which is playing a part in depressing the market. We've seen contracting levels at very low in 2016 so far, so there's been a real reticence to invest in the sector. There's clearly a level of uncertainty in terms of the long-term prospects. When we look further out, when we look beyond 2017, 2018, that kind of lack of ordering should help construct some recovery in the market. So the kind of lag effect from new building programs should be constructive for earnings over the long term and should help support a recovery in freight rates. And that plays a key part in our kind of assessment of over the 5-year period of tanker earnings.
Over that course of that 5-year tanker period, do you have a view on how many vessels are going to come off charter, so effectively are going to enter the spot market?
I mean, we're not tracking the time charter versus spot market in that kind of level of detail in our assessment. Really what we're looking at is overall capacity and versus overall levels of demand.
And finally, Tim, if I were to give you a hypothetical $150 million US and mandate you to invest it in the tanker market, what would you do with it?
Well, I think one of the areas in the tanker sector that we certainly point out to our clients is that there is a high degree of unification in earnings by sector. And if you look at earnings over a long period of time, you don't actually see a huge differentiation between sectors, even between products and crude. There are reasons for that in terms of the substitution potential between different sectors, but also as we see different demand trends developing, owners obviously shift towards different asset types. And certainly on the crude side, you're really looking at Asia being the dominant driver for imports over time, and certainly going forward we see that in terms of oil demand trends and refining capacity trends. As we see the market falling, potentially the opportunities are growing for investors to look at as second-hand asset prices fall, and the VLCC sector is the key component driving long-haul Asian crude imports, and that could become more attractive. In the product tanker sector, there's been a lot more interest in the larger areas of tonnage driven by growing Middle Eastern export capacity in the long range 1 and 2, LR1 and 2 tanker sectors. And despite the fact that they've seen low levels of earnings recently, in the long run, we still expect those to remain quite attractive sectors going forward.